Continuing topic 6 of paper 9, we're now going to consider value at risk, VAR, in section 1.5 of page 6.11. Now, value at risk is a standard statistical technique to assess risk. A little bit more detail, it measures worst expected loss over a given time interval under normal market conditions at a given confidence level. So let's look at an example. If an institution declared that its trading portfolio had a daily VAR of 100 million at 95% confidence, this would mean there's a 5% chance the daily loss will exceed 100 million under normal market conditions. Now that paragraph is what you need to know with regard to value at risk. But also an increase in asset price volatility will lead to a larger value at risk. So be aware of that relationship. And also increase in asset price volatility will lead to higher margins, margin calls. Okay. Will that come up in the exam? If it does, there'll be one question looking at value at risk. We now move on and consider margining systems, section 2. Now, margining, risk management tool used by the Hong Kong Exchange and Clearing Limited, the clearinghouses, to guarantee performance of contracts. Margins where you put forward a good faith deposit to cover potential losses. And that's just what we say, security deposits collected by the clearinghouses to cover any potential losses in the event of market moving against you. Now, brokers collect appropriate margin from clients and they pass them on to the clearinghouses. Both buyers and sellers of futures need to deposit margin. So irrespective of whether you're buying or selling, the moment you move into futures position, potentially very quickly, you could have incurred a loss because of the movement in the prices. And so you have to cover that potential loss with the margin. Option buyers do not need to post margin. So if you're buying an option like an insurance policy, you pay a premium. The maximum you can lose is the premium. But option sellers are exposing themselves to possible loss. Therefore, they must pay in margin, post margin. And then we're told portfolio margining system, prime margining method used by the clearinghouses at Hong Kong exchanges. I wouldn't worry too much about that for paper 9. Margining methods, margin levels vary with changes in values of underlying assets and volatility. So those are the two inputs to margin levels. There are 4 margin categories: initial margin, maintenance margin, intraday margin, and clearinghouse margin. Now the first 3, and this has been examined, the first 3, the initial margin, maintenance, and intraday, apply to clients. So that's what the clients will pay. While clearinghouse margin, that's the margin that applies to the clearing participants, not the clients. Now, the client margin is calculated by the participants, the clearing participants. The futures exchange will specify the minimum margin that the participant must collect from the clients, but the participants are allowed to insist on a higher margin from its clients, depending on the perceived risk of that client. Let's look at them in a little bit more detail. Initial margin paid when you open a position, and it provides cover against any loss that occurs when the position is first opened. But your position will move, and you could, the initial margin you've paid in may be eroded by cumulative losses. And if those losses take you below the maintenance margin level, you will get a margin call and you have to pay back up to the initial margin level. That's a favorite question. So the initial margin is the margin, the good faith deposit you put forward when you open your position. Then if that initial margin, the equity in that margin, is eroded because of losses, and your margin, the equity in your margin position falls below the maintenance margin, then you must contribute more margin up to the initial margin level. Intraday margins is where you get margin calls within the day because of extra volatility in the market. And the clearinghouse margins, well, every clearing participant has a continuing obligation to maintain the clearinghouse margin at the level and during the period from time to time stipulated by the clearinghouse. We've got two more sections left at topic 6 of paper 9. First one's derivatives clearing and settlement, and the second is over-the-counter derivatives trading and clearing. Now, with derivatives clearing and settlement, bang in the middle is the Futures Exchange Clearing Corporation. Now, the clearinghouse, clearing corporation, clears and registers futures trade, and it acts as a counterparty to both sides of every trade, thereby guaranteeing settlement of all contracts. Now, this guaranteeing of settlement is known as novation. And to show you how this operates, I've put together a couple of diagrams. The futures trade itself, which occurs on the Hong Kong Automated Trading System, HKSI, is between the buyer and the seller. But there will be a futures exchange participant representing the buyer, futures exchange participant representing the seller, that submit the bids and the offers into HKSI. Once you have a matched futures trade, it's passed on to DCAS, Derivatives Clearing and Settlement. And there the buyer and seller do not settle between each other. They both go through the Hong Kong Clearing Corporation, the clearinghouse, the futures clearinghouse, so that the clearinghouse buys from the seller and sells to the buyer, thereby guaranteeing settlement. Now, the notes underneath the diagrams: the clearinghouse must meet all liabilities should either party default, and that is the guaranteeing mechanism. While the clearinghouse obliged to meet financial obligation of the defaulting counterparty, the actual amount that they meet is limited to the margin collected and on deposit with the clearinghouse and the value of the clearinghouse's reserve fund, which they will apply. Now, the reserve fund been established by the clearinghouse to provide funds to cover defaulting clearing participants, and it comprises the initial participant contribution, interest income earned from the reserve fund deposit, and other resources as determined by the clearinghouse. And that last paragraph there, bottom of page 6.13, has been the subject of a question at paper 9 in the past. Page 6.14, over-the-counter derivatives trading and central counterparty clearing. Now, over-the-counter is where you have two counterparties trading between each other. You do not have the clearinghouse, you do not have the exchange. And so we have credit risk. We're told that the OTC market, a network of major banks and financial dealers. Now, the markets include electronic trading platforms hosted by their financial information provider, single financial institution or group of financial institutions, or an exchange. I wouldn't worry too much about that in detail. Now, the trade execution and confirmation, when it's OTC, over the counter, market is decentralized, where a trade can be executed directly, as I said before, between the two parties. Now, after the trade, the two parties send each other electronic confirmation of the deal, and then subsequently they will settle. But there is a risk, a credit risk, counterparty risk, and that can have an effect on market liquidity. And so regulators nowadays want to know where the major OTC derivative positions are. And as such, we have mandatory reporting. So those involved in the trades are required to report specified OTC derivatives transaction. The specification is a dollar amount. So they're only large amounts that need to be reported, but they should be reported to the Hong Kong Trade Repository. Well, although you report it to the repository, you must also be a member. So that moves on to an institution with a reporting obligation must become a member of the Hong Kong Trade Repository under the Hong Kong Monetary Authority. So please remember those two aspects. You have to become a member of the Hong Kong Trade Repository, which is part of the Hong Kong Monetary Authority. You do not have to become a member of the Hong Kong Monetary Authority. Reporting a transaction must be within 2 business days of the trade execution. Please be aware of that. And the trade repository covers the reporting of a number of product classes: interest rate derivatives, foreign currency derivatives, equity derivatives, credit derivatives, and commodity derivatives. And central counterparty clearing. Well, after the 2008 global financial crisis, many jurisdictions established their central clearing counterparties for OTC derivative transactions, and they introduced mandatory clearing when they introduced mandatory reporting. It has to be said the mandatory clearing is where there are extremely large positions, and I wouldn't worry about that for this exam. After OTC trades have been executed between the two clearing members register their trades with a designated clearing counterparty, which will assure clearing members have sufficient collateral to support the trades. That brings us to the end of topic 6, and indeed the end of paper 9. Now, paper 9 is a challenging paper, and pass rates can vary, but they rarely get beyond, I would say, 55% and can be down in the 20–30%. So this paper needs a great deal of work. There's a lot of technical material in it. So I advise that you read through the notes that have been provided and indeed refer to the HKSI official manual. But as ever, the best way to prepare for these exams is practice questions. And in doing the practice questions, focuses your mind on why you're getting them wrong. And through that mechanism, you can build up your short-term memory for the exam. And I would strongly recommend that you go to Examinator.online for the paper 9 practice questions. Good luck.